Good evening. Let us come to AS-11. So AS-11 has three parts. AS-11 has three parts. We have completed. First was transaction in foreign currency. First part was transaction in foreign currency. Then second part was translation of financial statement of foreign operations. These two parts we have covered. And now the third part is forward contracts. Third part is forward contracts. So everybody please come to third part now. This part may be little difficult for you, may be little difficult because probably you have not done this part. Okay. So anyway, I will try my best to simplify it for you. So all of you concentrate. What is a forward exchange contract? A forward exchange contract is a contract entered today. Contract is entered today to buy or sell. To buy or sell a certain quantity. To buy or sell a certain quantity of foreign currency at a certain rate on a certain date. So this is the meaning of forward contract and I will explain it to you now. So you enter into a contract today. Suppose today is suppose 2nd November. Today is 2nd November and you want to buy foreign currency on 30th November. So you are worried that the exchange rate will go up. You are worried that this exchange rate will go up. So what you will do? You will go to a foreign exchange dealer. They are called forex dealer. They are licensed by RBI to deal in foreign exchange. When will you go? You will go today. And you will enter into a contract today. And what is the contract? The contract is that you will buy $1,000 at the rate of rupees 76 per dollar on 30th November. So the contract is that let us call it Mr. A, and Mr. A goes to a forex dealer and enters into a contract today, that is 2nd November, to purchase $1,000 at the rate of 76 rupees on 30th November. On 30th November, what will happen now? On 30th November, Mr. A pays 1000 into 76,000 rupees to the forex dealer, and Mr. A receives $1,000 from the forex dealer. This is how the transaction will be settled on this date, that is 30th November. What is the benefit of this contract to Mr. A? Anybody would like to reply? Why would Mr. A enter into a contract today, that is on 2nd November, to purchase $1,000 after 1 month at 76? So tell me the advantage of this contract. Advantage from Mr. A's point of view. What is the advantage of this contract to Mr. A? Any reply from your side? Yes, waiting for you. Yes, come on, everybody. The benefit to Mr. A is that he is not worried about what will be exchange rate after 1 month. After 1 month, the exchange rate may be 80 rupees, 85 rupees. But he has a contract to purchase $1,000 at 76, and therefore irrespective of whatever is the exchange rate on 30th November, Mr. A will be able to purchase the dollar at 76 rupees per dollar. Okay. So Mr. A has protected himself from the loss. Mr. A has protected himself from the loss. So this is called a forward contract for hedging purpose. This is called a forward contract for hedging purpose. The purpose of this forward contract, this example given on the screen, is that Mr. A wanted to protect himself from the change in the exchange rate, and therefore he took the forward contract. So Tiwari and Tanya, you are right, to hedge against foreign exchange rate fluctuation. Forward contract can be taken for two purposes. Forward contract can be taken for hedging purpose. So our paragraph number 11 deals with forward contract for hedging purpose. To hedge means to protect from risk. To hedge means to protect from risk. If you are dealing in foreign exchange, if you are dealing in foreign exchange as a as an exporter or as an importer or as a borrower or as a lender. If you are dealing in foreign exchange as a exporter, importer, borrower or lender, you are exposed to foreign currency fluctuation risk. You are exposed to foreign currency fluctuation risk. If you are a borrower, lender, exporter or importer, you are exposed to foreign currency fluctuation risk. To protect yourself, to protect yourself, you can take or you can enter into a forward contract. You can enter into a forward contract. You can enter into a forward contract. So this will lock the price. Forward contract will lock the price. Forward contract will lock the price. So that is the advantage of forward contract. It will lock the price. So now you can sleep peacefully like you do every day. Exporter, importer can also sleep peacefully because the price is locked. He is not worried about exchange movement now. But then what about the accounting? The accounting is covered by AS-11. The accounting is covered by AS-11. One more line write down, those who are writing. Forward contract gives rise to gives rise to a forward contract give rise to a right as well as obligation. A forward contract give rise to a right as well as obligation. A forward contract give rise to a right as well as obligation. Okay? What do you mean by this? A forward contract give rise to a right. Refer the previous example. Mr. A has a right to buy $1,000 at 76. That is the right. And what is the obligation? He has an obligation to pay 76,000 rupees for buying $1,000. After 1 month, even if the dollar rate goes down to 70, still Mr. A will be under an obligation to buy dollar at 76. So you will not be able to benefit from the reduction in the exchange rate. That is also one problem here, because you have locked the rate. Once you lock the rate, you will not be able to enjoy any movement in exchange rate. Neither you will suffer loss, but at the same time, you will not enjoy any benefit also. So this is called forward contract for hedging purpose. So after understanding that, let us see the accounting part. This question has been asked for 10 marks in the exam. So I am explaining in detail, because 10 marks in our exam is too much. It can change your destiny forever. So suppose spot rate and forward rate. Spot rate means today's rate. Forward rate means contracted rate. Contracted rate means rate at which forward contract is entered into. So today's rate is suppose 70 and forward rate is 75. So this is called forward premium. This is called forward premium. Today's rate is 70 and forward rate is 68. This is called forward discount of rupees 2 per dollar. This is forward premium rupees 5 per dollar. Both are possible. Both are possible. Why both are possible? This is the market. Depending upon the demand and supply, sometimes the forward rate can be more than the spot rate. Sometimes the forward rate can be less than the spot rate. Both are possible. So the first point to be kept in mind is, this forward premium or discount at the inception means at the beginning. Inception means beginning. Forward premium or discount at the inception of the forward exchange contract, FEC means forward exchange contract, will be amortized over the period of the contract. Now understand the first one. I will take the first one only to explain, so no confusion. Today the rate of exchange between dollar and rupees 70, and you have exported goods of $1,000. You have entered into a forward contract at 75. So how much is the total premium involved? The total premium will be 1000 into 75 minus 70. So the total premium is 5000. Total premium is 5000. And suppose today the date is 1st January 2023. The forward contract date is 30th June 23. So this gap is 6 months. So this is a small thing you have to do. Today is 70, but forward contract is 75. So therefore, there is a gain or loss of 5000 rupees. there is a gain or loss of 5,000 rupees. If you are an exporter, there is a gain because you will get 5,000 more. But if you are an importer, there is a loss because you are paying 5,000 more. So the standard says this difference between spot rate and forward rate, that is your gain or loss by entering into a forward contract, will be amortized over the period of contract. Let us say our year ending date is 31st March 23. So what will happen? This 5,000 rupees will be amortized in the ratio of time. So 2,500 I will transfer to P&L account in the first year, and 2,500 rupees I will transfer to P&L account in the next year. Okay, you try one more. Suppose today is 1st February 2023 and the contract will mature on 30th June 23. Student will try. Number of dollar is 1000. Spot rate is 72 rupees per dollar, and forward rate is 77 rupees per dollar. Okay, and year ending date is 31st March 23. So you will say 2 months will fall in this year and 3 months will fall in the second year. Now the question is, what is the total premium here? The total premium here is $1,000 multiplied by 77 minus 72, that is rupees 5,000. The answer is rupees 5,000. So what we will do, this 5,000 rupees we will apportion 2 is to 3. 5,000 rupees will apportion 2 is to 3. So 2,000 rupees we will recognize in P&L account in first year, and 3,000 rupees we will recognize in P&L account in the second year. So that is my first rule. The premium or discount will be amortized over the period of the contract in the ratio of time. In the ratio of time, we are going to solve 2 questions or 3 questions on this, don't worry. Second thing, any exchange difference will be recognized in P&L account. Any exchange difference as usual will be recognized in P&L account in the year of change. This I am going to explain with the help of one example. Third point, any profit or loss on cancellation and renewal of forward exchange contract will be recognized in P&L account. Forward contract can be cancelled also. Forward contract can be cancelled. But if you cancel the forward contract, there is a penalty to be paid. There are some charges you have to pay for cancellation. Those penalty or those charges you will pay on cancellation will be recognized in P&L account. So you go to a forex dealer and say, sorry, I don't want this forward contract, please cancel. But as you know, this is a contract. You can't cancel on your own. The other party must also agree. So if the other party agrees, forward contract will be cancelled and you have to pay some kind of penalty for that. That will also be transferred to P&L account. Forward contract can be renewed also. Forward contract can be renewed also. My forward contract was supposed to mature on 30th June 23. Remember, My forward contract was supposed to mature on 30th June 23. I go to the forex dealer and I say, please, you renew it. You renew it to 30th September 23. Please extend this date by 3 months. I am not in a position to honor on 30th June. So you request the forex dealer to extend it by 3 months or 1 month. That is called renewal. The dealer will say, forex dealer will say, I will do it, but you have to pay charges. Are you willing to pay charges? Yes. Then in that case, they will renew, means extend. Whatever charges you are going to pay for renewal or cancellation, that will also be transferred to profit and loss account. Okay. So one good news I need to share first. So far the institute has never asked a question on the third point. So we have to only deal with the first and the second point. So I will just revise and then around 4 questions will be solved in the classroom. First is any premium or discount will be amortized over the life of the contract. Second is exchange difference will be recognized in P&L account in the period in which they occur. Any profit or loss on cancellation or renewal will be transferred to P&L account. Let us see the application of the theory. First, we will come to one question number 4. Question number 4, which is printed in your book. Question number 4. Next page probably. Question number 4. Sterling Limited purchased a plant for US dollar 20,000 on 31st December 2007, payable after 4 months. The company entered into a forward contract for 4 months. This is an exam question for 2 marks. Oh, only 2 marks. Can we ignore 2 marks? Tell me, how many of you would like to ignore 2 marks in your exam? Your 2 marks can make lot of difference. Okay. This contract is for 4 months at rupees 48.85. So this is forward rate. Forward rate is 48.85. On 31st December, the exchange rate is 47.50. Oh, so there is a forward premium involved. There is a forward premium involved because your forward rate is more than the spot rate. So Tiwari will not give up 2 marks. Very good, Tiwari. Right. So how much is the premium you are willing to pay to enter into a forward contract? The premium per dollar we are willing to pay is 48.85 minus 47.50. So tell me, 48.85 I have to pay. Today the rate is 47.50. So I am willing to pay 1.35 rupees per dollar as premium. And therefore my total premium in this would be 1.35 into the invoice amount is $20,000. So total premium you have to pay over the spot rate is 27,000 rupees. Is 27,000 rupees. So what I have to do? I have to search for year ending date. How will you recognize the profit or loss on forward contract in the books of Sterling Limited? So there is an year ending date here. 31st March 2008. This period is 3 months and this period is 1 month. So what the standard is saying, by entering into a forward contract, in this example, you will have a loss of 27,000 rupees. Why loss? Because you have to pay more. You are an importer of plant. Today, had you made the payment today, you would have paid 47.50, but actually you are going to pay after 4 months, and after 4 months you will pay at the rate of 48.85. So total loss 27,000 will be apportioned in the ratio of 3 is to 1 in our example. So 3 by 4 into 27,000, 20,250 transfer to P&L account for the period ended 31st March 2008, and remaining amount, that is 6750, we will recognize in the next year. So 27,000 Chaurasia is right, Gaurana is right, Pancharia is right. So loss of 20,250 in the first year and 6750 in the second year. If it is a 2 or a 4 mark question, this much is enough. Now read the answer from your book. They have done the same thing. I have just explained in the form of a diagram. I hope it was understandable. Any query? First tell me any query. Syllabus is vast, topics are a little complicated. We need to go really slow so that everybody understands. The objective is not to complete the syllabus. If that was the objective, we would have done it long back. So this is the answer. Let us read the answer from your book. In your book it says, same thing is written, forward contract 48.50, spot rate 47.50, the loss or the forward premium 1.35, total 27,000, time is 4 months, out of 4 months 3 months will be in the first year, so that will give rise to 20,250. 1 month will fall in next year, that will give rise to 6750. Any query? If you will respond, then only I can understand that do you need more explanation for this, because similar questions are getting asked in your exam. Similar questions are being asked in your exam, ranging from 2 marks to 5 marks. Okay. So in case if you don't have a query, then I will like to go to the next question. And before I forget, today's homework, those who are good student, you will solve all questions because today your chapter will get over. So before you go to sleep, solve all questions. And if you have a doubt, you will mail me. I repeat, you will mail me on my mail ID vinod_ca at yahoo.com. Okay. Question number, page number, AS number or chapter number, name, and photo of the question and the answer, and your query. 5 things you have to complete. Your name also you can put. Right. So let us go to next question number 3. Oh my God, the answer is not there. How will you do it? Question number 3, this time we will solve in detail. This was a 10 marks question in some earlier exam. Can you believe that? Question number 3, an exporter has $50,000 due in 6 months. Rate on the date of sale, that is today. Today is the sale. 1st January is 47. So rate on the date is 1st January. On 1st January is 47. So first let me explain. Today is 1st January. The rate is 47. If I add 6 months, it will become 30th June. The forward rate offered is, this is spot rate, this is forward rate 47.50. Oh, wonderful. All figures are rupees per dollar. Then year ending date is 31st March. So exactly in the center, you have 31st March. When the exchange rate was 47.20. When the exchange rate was 47.20. On the settlement date means 30th June. This is called settlement date also. On the settlement date, the rate is 47.60. So actual rate on 30th June is 47.60. Show the accounting including for forward contract. It is a forward contract to sell the foreign currency. It is a forward contract to sell the foreign currency. Is it right? Now, first of all, understand the rate given to you. Today the rate is 47 and you have entered into a forward contract at 47.50, which will be settled after 6 months. So therefore, if you compare this 47.50 with 47, there is a premium of 5 rupees. So the forward premium is 50 paise, 0.50. Difference between these two and multiplied by number of dollars 50,000. Multiplied by number of dollars 50,000. So total is, I think, 25,000. Total is 25,000. Do you agree? The total premium 50,000 is the total value of the invoice. Today the rate is 47, the highlighted numbers. Forward rate is 47.50. Only focus on spot forward. 50 paise. Difference into $50,000. So that is your 25,000 rupees premium. So 3 months in this period, 3 months in this period. So my calculation will be easy. 3 by 6 into 25,000. 12,500 premium we will recognize in this period, and similarly 12,500 premium we are going to recognize in the next year. So do you agree? Yes, Venu Gopal, do you agree? Your name is so interesting, Venu Gopal. Pancharia, no query. Gorana, 25,000 rupees. This is the 25,000 rupees. Very good. So now the question is, why these other rates are given? The other rates are, year ending rate is given 47.20. Actual rate in the market on 30th June. Actual rate means what actually happened is 47.60. So therefore, we need to understand, you are under AS-11. When you are going to export goods, you are going to have a foreign currency debtor. AS-11 says, AS-11 says a foreign currency debtor is a monetary item. A foreign currency debtor is a monetary item, and monetary items are required to be restated. Monetary items are required to be restated at the closing rate. That is why closing rates are given. And when the debtor is going to make you the payment on 30th June, you are going to receive the amount paid by debtors $50,000 into 47.60. Is it right? So that is why you are given exchange rate on 31st March also and 30th June, because we have to also simultaneously apply AS-11 in my books of account. Okay. So first write down a note. First write a note. This is a forward contract for hedging purpose. Note. This is a forward contract for hedging purpose because the exporter wants to hedge the exchange risk. The exporter want to hedge the exchange risk. There is a real risk here. He is going to receive dollar after 6 months. Dollar rate can change, and if the dollar rate changes, the exporter can expect a loss, can suffer a loss, and therefore he wants to hedge himself. Okay. So how do you know in the exam whether it is for hedging? They will mention he is an exporter, he is an importer, he is a borrower, he is a lender, and because of that we are able to estimate that he is hedging it. He is hedging his risk. Okay. There is some genuine risk in this forward contract, and the genuine risk is that he has to receive $50,000, and therefore if he does not hedge, and if the dollar rate crashes, dollar rate becomes, suppose in this example, 40 rupees, then he will be able to convert at 40 only. So he does not want to take that risk. He enters into a forward contract. Now write down next thing here, next line. Total forward premium, total forward premium is equal to $50,000 into bracket 47.50 minus 47, and that is rupees 25,000. That is rupees 25,000. So this is my total premium in this deal. Okay. Now I am going to pass journal entries. So please write down books of exporter. Books of exporter. Listen to me carefully, you will not have problem later. And if you don't listen to me carefully, then you will get confused. So this question is very, very important. And if you don't do in advance, you will not be able to understand later. So everybody, please draw one page format. One page, yes. Full page, yes. Journal entries. Date, particulars, debit, credit. Answer is not printed in your book purposefully so that you will pay more attention. This was a purposefully done. So first you write down normal entry for sale. Year is not given, so don't worry. Just write down January 1. 1st January, there is a sale transaction. Entry will be sundry debtors account debit to sales, and the amount will be $50,000, $50,000 into today 47. So you have to today help me because I don't have calculator. Yesterday I sold my calculator for $200. Okay, and I'm yet to receive the amount. So this is 23 lakh 50,000. Today, if you help me, God will help you in the exam. 23 lakh 50,000 being sales recorded, being sales recorded at spot rate, being sales recorded at spot rate, being sales recorded at spot rate. This is normal entry. 11 standard student can also do it. Okay, now on the same day, 1st January, same day, this entity exporter goes to a forex dealer, goes to a foreign exchange dealer, and they enter into a contract. They enter into a contract. What is the contract? Exporter will give to this forex dealer, exporter will give $50,000 after 6 months. What is obligation of exporter? The obligation of the exporter is to deliver $50,000 after 6 months. And what is the forex dealer obligation? The forex dealer's obligation is, or you can say, the forex dealer will pay him 50,000 into 47.50 because forex dealer has to pay him Indian rupee at the rate of 47.50. So that is coming to 23 lakh 75,000. If you can understand this much, my job will be easy. Exporter has an obligation to pay $50,000 to forex dealer. This is the contract. And forex dealer has the obligation to pay 23 lakh 75,000 rupees to the exporter. I repeat third time, exporter has to pay $50,000 to the forex dealer and forex dealer has to pay 23 lakh 75,000 rupees to the exporter. We are in the books of exporter. We are in the books of exporter. So exporter has to, on the screen once again, highlighter, exporter has to receive 23 lakh 75,000 from forex dealer and exporter has to pay, there is a payable also, $50,000 after 6 months. So what the exporter will do now, exporter will create in the books of account on the same date 1st January a receivable and a payable. So he will pass an entry forward contract, forward contract receivable in bracket rupees account debit 23 lakh 75,000. Calculation will be 50,000 into 47.50 into 47.50, that is receivable. And he has a payable also. He has a payable also to forward contract payable. To forward contract payable. He has to pay $50,000. He has to pay $50,000, but because this entry we are recognizing today, I will apply spot rate. I will apply spot rate, that is your 23,50,000, because AS-11 says transaction should be recognized on the basis of the exchange rate on the date of transaction. This is my foreign currency transaction. Hence, it will be applied using spot rate. Whereas this is my rupee transaction. I have to receive rupee. So, rupee amount I have to receive. There is no conversion involved in this one. But there is a conversion involved here, because here I have to pay $50,000. It is not telling. The difference we will call to forward premium account. To forward premium account 25,000. Automatically the difference 25,000 has come. Okay. Being forward contract. Being forward contract recorded. Being forward contract recorded. Being forward contract recorded. Okay, a good student will note down everything. He will not leave anything to the chance. Now this is the date of transaction. Then we will come to 31st March. Then we'll come to 31st March. What will happen on 31st March? So again, let me first draw the format. You will continue below. So 31st March, out of this 25,000 rupees, as we have discussed, 3 months, 3 months. So 12,500 rupees I will recognize in P&L account in this year, and 12,500 I will recognize in the next year. So my next entry will be forward premium account debit 12,500, 3 by 6 into 25,000. This is called pro rata allocation to P&L account, 12,500, to P&L account 12,500, being proportionate premium transferred to P&L account, being proportionate premium transferred to P&L account, being proportionate premium transferred to P&L account. So wait, answer is not over. On the screen, I'm back to the question. Now the question, third line on the screen, year end rate on 31st March is 47.20. Year end rate on 31st March is 47.20, and the opening rate is 47 here. So your debtor is a foreign currency debtor. Your debtor is foreign currency receivable. You have to receive $50,000 from the debtor. So it is a foreign currency monetary item. And similarly, you have to pay $50,000 to the forex dealer. So you have a foreign currency payable. You have a foreign currency receivable in the form of debtor, and you have a foreign currency payable in the form of liability towards forex dealer. Both these items, being a monetary item, being in foreign currency, will be revalued, and therefore we are going to record now two more entries. 31st March, 31st March, sundry debtors account debit, sundry debtors account debit, sundry debtors account debit to exchange difference in bracket P&L account. Otherwise, I will have to pass a separate entry for transferring to P&L account. So sundry debtor, now the student will answer me what will be the amount. When the debtor was recorded on 1st January, the rate was 47. Now the rate is 47.20. So the rate has gone up from 47 to 47.20. So multiply 47.20 minus 47 into $50,000. So this will give you 0.20 into 50,000, 10,000 rupees exchange gain. Enjoy. This will give you 10,000 rupees exchange gain. Okay. Being debtor revalued. Being debtors revalued. Being debtor revalued. Being debtor revalued because it's a monetary item. Being debtor revalued as okay. There is one more foreign currency monetary item, and that is forward contract payable in dollar. You have an obligation to pay $50,000 to your foreign currency dealer. This was also recorded at 47. Can you see that? So this also will be revalued, but because it's a liability, the rate has gone up, there will be a loss. So the entry would be now same date 31st March, 31st March, exchange difference in bracket P&L account debit to forward contract payable, to forward contract payable in bracket dollar account, and the calculation will be same. The calculation will be same, 50,000 into 47.20 minus 47, 10,000 rupees. Credit side also 10,000 rupees. So effectively there is no effect because of the exchange fluctuation. Only if you look at the whole story, only this 12,500 rupees goes to P&L account, and exchange difference on debtor and forward contract, they are cancelling out each other. So you will say there is no need to pass the entry. There is a need to pass the entry because as per AS-11, monetary item will be translated at closing rate. Debtor is a monetary item. Foreign currency forward contract payable in dollar is a monetary item. So therefore they will be revalued. Now listen to me carefully. After passing these entries, the balance in sundry debtor account will become Debtor balance will become 23,60,000. Do you agree? And the forward contract payable account balance will also become 23,60,000. Both will increase by 10,000. And the forward premium account balance after transferring 12,500 to P&L account, the forward premium balance will be 12,500. So I will just write it for you. Balances as on 31st March, year is not given, so just write on 20XX. We have 4 items in my question. Debtors. Debtors are dollar denominated debtors. The balance is 23,60,000 debit. Then I have a forward contract. I have a forward contract receivable account in rupees. The balance is 23,75,000 debit. Then I have a forward contract. I am making a list of the ledger account balances which I have. Forward contract payable in dollar. That means my liability is in dollar and the balance is 23,60,000 credit balance. And I have a forward premium account balance. I have a forward premium account balance 12,500 rupees credit balance, because out of 25,000 we have already transferred 12,500 in the P&L account. So these are my balances. Okay. So journal entry continues. Journal entry continues now. All action will be now shifted to June 30. All action will be shifted to June 30. All action will be shifted to June 30. Okay. So in June 30, what I'll do? First, this balance in forward premium account, I will transfer to P&L account. Forward premium account debit 12,500 to P&L account 12,500 to P&L account 12,500. Balance in forward premium account, balance in forward premium account transferred to P&L account. Balance in forward premium account transferred to profit and loss account. One account has closed now. One account has closed. Now we'll come to same June 30. June 30 date column. Now come back to your question first. On the question, if you see, on 30th June, the rate was 47.60. Now understand what will happen. This is the entity. This is the data of the entity. On the screen, understand. And this is this forex dealer. This is the forex dealer. So debtor will give me $50,000. Debtor will give me $50,000. So this I will convert at the spot rate today, which is 47.60. Which is 47.60. Then I will have to pay I have an obligation to pay $50,000 to Forex dealer because it's in foreign currency. This will also be converted at 47.60. The moment I hand over $50,000, Forex dealer, Forex dealer will hand over me the contracted 23 lakh 75,000 rupees. So I will enter into three entries now. Debtor will give me $50,000, which I will convert at spot rate today. I have to pay $50,000 to Forex dealer, which I will convert at spot rate, and then Forex dealer will pay me rupees 23 lakh 75,000 as per the contract. So ready for three entries now. So this will be entry 1 here, second entry, third entry. So there are three transactions which will happen. Debtor will pay $50,000, entry for that. I will pay $50,000 to Forex dealer, entry for that. Forex dealer will pay me 23 lakh 75,000, entry for that. So let us come back. It's very easy. Don't worry. So on 30th June, debtors will pay me $50,000 and the exchange rate on that day is 47.60. Multiply 50,000 into 47.60. So I will get in my bank 23 lakhs 80,000. But the debtor balance in my book is only 23 lakh 60,000. So two debtors 23 lakh 60,000 and two exchange difference. This exchange difference will go to P&L account. That comes to 20,000. To exchange difference 20,000. Being debtors settled. Being debtors settled. So we have done settlement with debtor. He paid me the amount. I converted into rupees. But then I have to pay $50,000 to the dealer now. So next entry June 30 again. June 30. I will have to settle this liability first. Forward contract payable. Forward contract payable. Account debit. 23 lakh 60,000. Exchange difference. Account debit. I will write the number later. To bank. I have to pay him $50,000 today as per our contract, and today the rate is 47.60. So this will come to 23 lakh 80,000. 23 lakh 80,000. So there is a difference of 20,000. Balancing figure 20,000. So you will find again in this question there is no net effect in P&L account because of these two transactions. Loss in one is compensated by gain in another one. And the last thing now, I have handed over $50,000 to the dealer. I will go to the dealer and dealer will hand over me the rupee amount which he had promised to me. So dealer will pay me 23 lakh 75,000. Bank account debit. Here the narration read on being forward contract payable account settled. Being forward contract payable account settled. Previous one, the narration is being forward contract payable account settled. Now the last entry, enjoy. Bank account debit. bank account debit to forward contract receivable account. Now this will be a fixed amount, a logged amount which the dealer had promised me to pay in rupees. This is not a foreign currency monetary item. This is in rupee. No conversion involved. Being forward contract settled. Being forward contract settled. Now you will see all these accounts have closed. Go through the question. You have solved one of the most challenging questions of your life till date. Yes or no? You have solved one of the most difficult questions of your life till date, but can't help it. This is in your syllabus, and they have asked in the past up to 10 marks. Okay? Yes, Chauhan, any query? Ghorana, any query? Venu Gopal, any query? Pancharia, any query? Okay, so no queries from the student. If you have query, you can ask me later, but this answer is over. Now we'll come to question number 2. Question number 2 is a similar question. So I'm going to explain this to you, and then you will do it as homework. Answer is printed, and you can see it is mentioned there 10 marks question from actual exam. 10 mark actual exam question. So if you want to take a risk, you can. Question is, on 1st February 2008, an Indian company sold goods to an American company for an invoice price of $20,000 when the spot rate was 48.10. Payment was to be made in 3 months time. That is, the due date is 1st May 2008, which is given in the problem. To avoid the risk of foreign exchange fluctuation, the Indian exporter acquired a forward contract to sell US dollar, forward contract to sell US dollar at 47.90. So your forward rate is 47.90 rupees per dollar. Now the difference is, this time there is a discount. Previous question had a premium. This question has a discount. Don't worry. Wherever you have written forward premium, it will become forward discount. That was on the credit side. This will be on the debit side. Remaining discussion is same. So how much is the discount? Total discount will be 20,000 into 48.10 minus 47.90. So this is only rupees 4,000. Total discount is 4,000. And the year ending date is 31st March 2008. So this is 2 months. 2 by 3 into 4,000 will be recognized in the first year, and 1 by 3 into 4,000 will be recognized in the next year. In addition to that, you have to pass entry for sundry debtors to sell. At the end of the year, you'll have to pass entry for forward contract receivable, forward contract payable, and the discount will also be recorded on 31st March. Out of the total discount, or the discount which will record on 1st February, 2/3 of that 4,000, which comes to 2,667, you will write off in P&L account on 31st March. On 31st March, you are going to revalue two things, debtor and forward contract payable in dollar account. Then you will go to 1st May. On 1st May, the remaining amount of forward discount will be transferred to P&L account. You will receive the amount from debtor. You will make payment to forex dealer and you will receive the rupee amount from forex dealer. So 4 entries you have to pass on 1st May. Is it right? And 3 entries you have to pass on 31st March and 2 entries you have to pass on 1st of the February. If you look at your book, the entries are written, calculations are written, narrations are written exactly in the same way we have done. This contract is for hedging. Just write down in your book somewhere. This contract is for hedging. This contract is for hedging purpose. How do you know it is for hedging purpose? It's written here. To avoid the risk of foreign exchange fluctuation, the Indian exporter acquired a forward contract because he was worried that the exchange rate may go down and he might suffer the losses. Therefore, he entered into a forward contract. So, this question is your homework. I have given you the answer in detail. Do it. If you have doubt, you will ask me. Now, the last part of this question is, or before we go to the last question part, there is one question number 7 in the next page. After 2 pages, question number 7 will be there. Let us discuss this also. ABC Limited has taken a loan a few years back. An amount of $1 lakh is due for payment after 3 months. It enters into a forward cover for a period of 3 months at 47.90, whereas the spot rate on the date of contract is 47.10. Where the spot rate is 47.10, how should this be recorded by ABC? So first of all, you should mention that this is a contract for hedging. This is a contract for hedging. Why it is a contract for hedging? Because there is a loan behind it. Genuine reason. You have to repay the loan. And if the exchange rate goes up, if the exchange rate goes up, you will have to pay more rupees. Today the exchange rate is 47.10, but after 3 months, it can be anything. Future is uncertain. So what it does, to protect itself, it goes to the foreign exchange dealer and locks the rate at 47.90. So how much more it has to pay? It has to pay a premium of 47.90 minus 47.10 and multiplied by 1 lakh, that comes to rupees 80,000. It has to pay a premium of 80,000. Now this question has a problem. What is the problem? Year ending date is not given. Year ending date is not given. In fact, there is no date given. So what you will have to do, you just have to write a note, rupees 80,000 will be amortized. Answer is printed in your book over the period of the contract. Over the period of the contract. rupees 80,000 will be amortized over the period of the contract. Right, so this is the answer of this question. Nothing can be done more than this because the dates are not given in the problem. So mark question number 7 important for 4 marks. Question number 2 and 3 important for 8 to 10 marks. Question number 4 was important for 2 to 4 marks. Okay. Now we'll come to the last part of this chapter, forward contract for trading or speculation purpose. Forward contract for trading or speculation purpose means not for hedging. Not for hedging. It means the forward contract is taken just to earn profit, just to earn profit due to fluctuation in exchange rate. That is called speculation. Okay, your interest is not in foreign exchange, but your interest is to make profit because exchange rate is expected to change in the future period. Like today, the exchange rate is 76 rupees per dollar. Today, exchange rate is 76 rupees per dollar. Tiwari is thinking, our student Tiwari is thinking that after 3 months, Tiwari is a big time gambler, the great gambler, the great speculator. He is thinking that after 3 months, I believe, Tiwari believes that exchange rate will become 82 rupees per dollar. Wah, Tiwari, wah. Tiwari believes that after 3 months, exchange rate will become 82 rupees per dollar. Tiwari is not an exporter. Tiwari is not an importer. Tiwari is not a borrower or a lender. Tiwari is just an ordinary intermediate student. Okay, that's it. But Tiwari is a smart person. He thinks that today the rate is 76. In 3 months' time, Tiwari is expecting. Expecting means he thinks, just like in share market. Some of you purchase shares of Reliance today. Why? Because you are expecting that after some time share price will go up. Exchange rate is price of dollar, price of a foreign currency. So just like you speculate on share, there are people who speculate on foreign currency and you can do it. Who stops you? The law of the country allows you to do it. You can do it. So Tiwari, what will Tiwari do? Tiwari will enter into a forward contract to buy dollar. Tiwari will enter into a forward contract. Tiwari will enter into a forward contract. Tiwari will enter into, understand, only then you will understand the answer. If you don't know what is forward contract for speculation, you will not understand the entry. And because they are asking such questions in the exam, I can't take it lightly also. Tiwari enters into a forward contract to buy USD. He goes to a forex dealer. Forex dealer says the forward rate is 77 rupees per dollar. Forward rate is 77 rupees per dollar. Tiwari started dancing. Dang, dang. Okay, so now Tiwari is dancing because Tiwari knows after 3 months I will purchase from the forex dealer at 77 and I can sell to my friend Kunal at 82 and I will earn a profit. So this is what is called forward contract for speculation or trading. Here the objective is not to hedge the risk. The objective is to make profit because you are expecting that exchange rate is going to move up or move down in a certain direction. One more example I will give you. Okay, Tiwari's friend is called Kunal. Oh, Tiwari's friend is Kunal. Spot rate. Today the spot rate is 76 rupees per dollar. But Kunal is thinking in a different way. Kunal is thinking that exchange rate may fall. Kunal is thinking that in India the dollar inflow has increased. The supply of dollar has increased so much in India that exchange rate will fall after 3 months. He has a different view. Possible? Yes. Is it possible? Yes. Exchange rate may fall after 3 months. Let us say it may become it may become 70 rupees after 3 months. This is what Kunal is thinking. What will Kunal do? What should or what will Kunal do if he is expecting that the dollar rate will fall? This they will not explain in your institute's material or any book on this planet Earth. You have to listen to me only. Kunal is thinking that dollar rate will fall to 70 rupees per dollar after 3 months. What should Kunal do? So enter into Kunal will enter into a forward contract. Kunal will enter into a forward contract to sell dollar because he is expecting the rate will fall. Kunal goes to a forex dealer. He says, I want to sell you dollar after 3 months. At what rate you are willing to buy? So forex dealer says, I am willing to buy at 75 rupees per dollar after 3 months. You can come, you can sell me dollar at 75. Oh, Kunal is dancing now. Because Kunal is thinking that after 3 months, market rate will become 70. Kunal is thinking, from the market I will buy at 70 and I will sell to this idiot forex dealer for 75 and I'll make a cool profit of 5 rupees per dollar. Is it right? This is called forward contract for speculation. But the question is, what is AS-11 saying on this? AS-11 says, what is your objective? To earn profit. Of course, you can incur loss also because you are speculating, you are betting, you are gambling. Okay, so in betting, gambling, speculation, there can be profit, but there can be loss also. So therefore, every time the exchange rate will change, you have to see what is your gain or loss and record it. Okay, so with every movement in exchange rate, you will calculate your gain or loss and record it. So dear student, please come to paragraph number 12 in your book. Paragraph 12. Last part, few more minutes. So now, paragraph 12, the heading is forward exchange contract meant for trading or speculation. I have explained with two examples. Tiwari's example, Kunal's example, what is speculation. They are student, ordinary intermediate student, but they are betting on dollar. that is speculation. They have nothing to do with the dollar. They only want to make profit. So first rule is any premium or discount on the forward exchange contract is ignored and not recognized separately. So first rule, if it is for hedging, if it is for speculation purpose, no accounting treatment, no accounting treatment of forward premium or discount. Like we have done in the case of hedging, this time you will not do it. Okay, this time you will not do it, just ignore it. So there is no need to compare spot rate with forward rate. The meaning of this line is that those who want to write, no need to compare, no need to compare, because the objective is different. No need to compare spot rate and forward rate. But then what will you do? On every reporting date, on year ending date, at each balance sheet date, the value of the contract is marked to current market value and the gain or loss on the contract is recognized. This is important. On every reporting date means balance sheet date, till settlement, you will see what is the value of this forward contract now, what is the value of this forward contract on the reporting date or on the settlement date, and any gain or loss will be recognized immediately. I am saying both gain or loss. Gain will also be recognized, loss will also be recognized. So because the objective is to make profit or loss, the standard says as the exchange rate will change, you will calculate how much gain or loss you are making on this contract. How much gain or loss you are making on this contract, and accordingly you recognize the gain or loss. So that is called marking to market. Marking to market means on reporting date you will say how much is your gain or loss, potential gain or loss, because the contract is not settled. Till it is settled, it is potential gain or loss. Calculate the potential gain or loss and recognize it in P&L account. How to calculate the gain or loss? I have given a small formula in your book. How to calculate gain or loss. Just 5 minutes more today. Okay. How to calculate gain or loss? So gain or loss is equal to foreign currency amount into forward rate at reporting date for remaining period maturity minus the contracted forward rate. And the treatment is the gain or loss computed will be transferred to P&L account. This you note down in your book if it is not printed. Gain or loss will be recognized in P&L account. So only one thing you have to do, on every reporting date till settlement date, you have to apply this formula and see whether you are gaining or losing, and accordingly recognize the gain or loss. So this portion is little complicated for you. Don't worry, I am there. So suppose Gopal entered into a forward contract to buy $10,000 at rupees 72 rupees per dollar on 1st January 2023. Gopal entered into a forward contract to purchase $10,000 at rupees 72 per dollar on 1st April 23. No entry will be passed here. Don't compare spot rate and forward rate. Now directly we will see how much gain or loss will happen on this contract. This contract will mature on 30th June. Maturity date is 30th June 2023. Forward contracts have a maturity date. Every forward contract will have a maturity date, that is, this is the date when the parties will settle their contract. So Gopal has entered into a contract to buy at 72 rupees per dollar. So what Gopal is thinking? Gopal is thinking that exchange rate will go up. Gopal is expecting that exchange rate will go up. Okay, so now this is 31st March 2023. This is 31st March 23. So what Gopal will do? Gopal will check in the market. What is the rate for dollar? So Gopal will inquire from the market 3-month forward rate, not spot rate, 3-month forward rate. That is today, what is the exchange rate for remaining maturity? That means today if somebody wants to enter into a forward contract which will also expire on same date, that is called remaining maturity, what is the forward rate? The forex dealer says, if you want to enter into contract today for a 3-month maturity forward contract, the 3-month forward rate today is 74 rupees per dollar. Oh, so what will Gopal think? Gopal will be happy or sad? Option A. If Gopal comes to know that the 3-month forward rate in the market is 74, whereas he has entered into a contract to buy at 72, will Gopal be happy or sad? If you can give me this answer, my job is done. Will Gopal be happy or sad? On 31st March, the forward rate available for June maturity is 74, whereas originally Gopal has entered into a forward contract at rupees 72. Gopal was expecting rate will go up. Rate has started going up. Rate has started going up. So Gopal will be happy because he was expecting rate will go above 72. From the market condition, it appears the rate has started going up. So 2 rupees potential gain to Gopal. 2 rupees potential gain to Gopal. So on 31st March, Gopal will recognize 10,000 into 74 minus 72, 20,000 rupees gain. 20,000 rupees gain will be recognized. I will just change the question slightly. Suppose instead of 74, quickly answer Gogoi. Then I will, rate is 70. 3-month forward rate on 31st March is 70. That means the same forward contract can now be entered into at 70. So what Gopal was expecting, rate will go up. What market is indicating, the rate is going down because now the forward is available at 70. Will Gopal be happy or sad? Will Gopal be happy or sad? So this time Gopal will be sad because there is a potential loss of 2 rupees now. So 10,000 into 2 rupees, Chauhan is right, 20,000 loss he will have to book. Okay. So this way we will calculate the gain or loss on every reporting date till maturity date, and on maturity date the final gain or loss will be calculated and that will be settled. Sad. Kunal is saying sad. Ranjit is saying sad. So what I have done, because you don't know about forward contract, please complete this table. This is from my side to the student. Okay, so student will quickly write situation, position, rate goes, and last column is gain or loss. So situation number 1, we have bought forward, like this example of Gopal, which is called long position. This is technical word. In your exam, if they say Gopal has entered into a long position, it means Gopal has entered into a forward contract to buy. Gopal has entered into a forward contract, long position forward contract. So he has contracted to buy. If you are finding that the rate is going up, Gopal will gain. Gopal will gain if you buy forward and the rate goes up from 72 to 74. Rate goes up, gain. Reverse. Reverse now. We have bought forward, long position, but the rate is going down from 70 to it has become 70. Rate is going down. There is a potential loss. There is a potential loss. So Gopal will feel sad. Second example which I had given you, Gopal will feel sad. Reverse. Third position, third situation, we have sold forward. We have sold forward is called short position. We have sold forward is called short position. Suppose the question says Gopal has entered into a short position. It means he has entered into a contract to sell. Rate goes up, loss. Rate goes up, loss. Reverse. If you buy, rate goes up, gain. So if you sell forward and the rate goes up, there will be a loss. Opposite. When you are taking a short position or when you are selling in the forward market, you are expecting price will fall. But if the price goes up against your expectation, loss. Last, we have sold forward short position and the price goes down. Now, smile. You are expecting price will fall and price has gone down. Therefore, there will be gain. Okay. So this is about how to calculate gain or loss. So just write two more lines. Forward buyer expects price will rise and forward seller expects price will fall. Forward seller expects price will fall. So if you expect something and if that happens, you will be happy. But if you expect something, and if something else happens, reverse happens, you will be sad. Okay? So let us go to our question number. This is question number 5. Question 5 below, or after that, next page. Check wherever it is. So this question is for speculation. A party enters into a contract for trading or speculation. Contract is to sell $1 lakh due on 30th June 14 at rupees 47.50. Today the spot rate is 47. On 31st March, that is year end, the forward contract for remaining maturity is remaining maturity to sell dollar is available at 47.55. Rate on 30th June, actual settlement date is 47.60. Account for the transaction. So first you understand the forward contract is for speculation. First point is the forward contract is for speculation. Second point, this forward contract is to sell dollar. That is, the expectation is that dollar rate will fall. The expectation is that the dollar rate will fall. Okay. Now see what happened. What happened on various dates. On 31st March, the rate was, the 3-month forward rate was, if you enter into a forward contract now for remaining maturity, that is 3 months, the 3-month forward rate is 47.55, and on this date, that is on 30th June, the actual rate is 47.60. Actual rate is 47.60. Forward contract was entered into at the rate 47.50 on 1st of January. This is the timeline. Spot rate is not relevant. Spot rate on 1st January, you will write, is irrelevant. Spot rate on 1st January is irrelevant. Some figures are given to confuse you. The spot rate 47 is irrelevant if the contract is for speculation purpose. Okay. So I am going to now pass journal entries. Pass journal entries. First entry, I think it is written in your book also. On 1st January, 1st January, look into your book. No entry. As per AS-11, no treatment for the difference between spot rate and forward rate if it is for speculation. Tick mark in your book, no entry. Answer is printed. Then you come to 31st March. And now you see what is your forward rate, 47.50. Forward contract was to sell. Forward contract was to sell. So expectation was that the rate will fall, but the rate has actually gone up. So there is a potential loss. So you will pass an entry for loss. P&L account debit to provision for forward contract. To provision for forward contract. And what about the amount? 1 lakh dollar into difference between 47.55 minus 47.50. So that is your 0.05 into 1 lakh. So the answer is you will recognize or you will make a provision for loss. You will make a provision for loss of 5,000 rupees. So this is the entry on 31st March. Now I will go to maturity date. The maturity date is 30th June. What did I find? I found that the rate actually is now 47.60. I was expecting rate will fall, but the rate has gone up. The rate has gone up. So already I have recorded a loss of 5,000 rupees. Now I am going to compare these two numbers. This is called mark to market. Difference between 47.55 and 47.50 I have recorded. So next time the comparison will be between these two. I suffered a further loss of 5,000 rupees. I suffered a further loss of 5,000 rupees. So what will be the journal entry now? The journal entry now will be, listen to me carefully, on 30th June, I will make a further loss entry of 5,000 rupees. P&L account debit 5,000. Why 5,000? Student will write 1 lakh into 47.60 minus 47.55. Now this provision account I will reverse. Not required. Provision account debit 5,000 because the contract is being settled. Provision account debit 5,000 and to bank I will have to pay the loss. I have to pay. I was expecting rate will go below 47.50, but the rate has actually gone up 47.60. So I will have to pay the differential 0.10 to the forex dealer multiplied by 1 lakh. So I am actually losing 10,000 rupees, and out of this 10,000 rupees loss, I have booked loss of 5,000 in the first year and I have booked 5,000 loss in the next year because the whole contract falls in two accounting period. It is now not based on time. Coincidentally, amount is same, but it is based on actual calculations of gain or loss. Okay, so this is my answer for this question. This question number 5, I will call it as case 1. Now what you do, you make a small change in this question number 5 and call it case 2. Call it case 2. So what I have done, I have just made some changes. In your notebook, write down, in your notebook, question number 5, case 2, and just write down 2-3 lines. Forward rate 47.50. 3-month forward rate 3-month forward rate on 31st March is 47.55 and actual rate on 30th June, only write 3 lines, actual rate on 30th June is 47.40. So what have I changed? I have changed this one. Suppose in your question, your institute plays a trick with you. Instead of giving 47.60, they have given you 47.40. So first the rate has gone up. So you felt sad. Then the rate has gone down. So you will enjoy. From 47.50, it became 47.55 and then 47.40. So here you will feel sad. But here again, the smile will come back to your face. So this time what happened? Ultimately, when the settlement took place, I gained. So first I will record loss, but later when the settlement will be done, I will record gain. So how to do the accounting? Let us write down. Okay, let us write down the accounting. First January, no entry. 1st January, no entry. 31st March, we are we are losing. 31st March, we are losing. So you will say P&L account debit 5,000 to provision for forward contract 5,000, 1 lakh dollar into 47.55 minus 47.50 minus 47.50. Up to this, the two questions are same. Now I have changed the question. On 30th June, on 30th June, the rate has actually gone down as I was expecting. So I will receive from the forex dealer the difference between 47.50 and 47.40 because I've entered into a forward contract to sell at 47.50. Market rate is 47.40. So I can take from the market at 47.40 and I can sell at 47.50. So therefore there is a difference of 0.10. 0.10 I will receive bank account debit. This time I will receive $1 lakh into difference between 47.50 and 47.10. So in the ultimate analysis, I will earn 10,000 rupees. Okay. Then I have created a provision account. Provision account reverse. Provision for forward contract. Reverse it and close it 5,000. To P&L account 15,000. To P&L account 15,000. Either you can understand like this or you can understand like this, $1 lakh. The rate has gone down from 47.55 to 47.40. So this is how the problem will be solved if the rate first goes up and then goes down. Have you noted it? Have you noted this? If the answer is yes, I'm going to revise the case. First, it will go down and then it will go up. It will go down and then go up. That is also possible. So student will now write case number 3. Case number 3, you write down like this: forward contract, forward contract to sell dollar at 47.50. This is same. But what I have done, I have made a change. 3-month forward contract, 3-month forward rate on 31st March is 47.40. This I have changed. This I have changed rupees per dollar, and then actual rate on 30th June, this also I have changed, is rupees 47.30 per dollar. Oh my god. Forward rate was entered into at 47.50. It is 47.40, and again it has gone down to 47.30. So here also you will be happy. Here you will be bigger happy. As long as the rate is falling, and if it is a forward contract to sell, you will become happy, 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 more happy. Okay. So here I am making a potential gain of 1 lakh into 0.10, 10,000. Here also I am making a profit of 10,000. Same difference. And my total gain will be 20,000 rupees. Difference between these two, I will get 20,000 in my uh, bank account when I will settle it. So write down the journal entry. Journal entry for this question. Institute can do anything with you. You will by heart one thing, and then they will change the number, and now the student will worry what will happen to me. So let us write down journal entries for case 3. Case 3, 1st January, no entry. 31st March, this time rate has gone down and I have contract to sell, so I have a potential gain. So I will just write like this: forward contract account debit to P&L account. To P&L account, 1 lakh dollar into the difference between 47.50 and 47.40, which is 10,000 rupees. So I am having a potential gain of 10,000 rupees. I am having a potential gain of 10,000 rupees. And then I'll come to 30th June, which is your settlement date. I find the rate is 47.30 and it is a settlement date. So I will recover from the counterparty the difference between the rate at which we entered the forward contract and the actual rate, which comes to 20 paise multiplied by 1 lakh dollar. So I will earn from speculation, I will earn from speculation 1 lakh into 47.50 minus 47.30, which is 20,000. So 20,000 rupees I will get in my bank account, and I will close this forward contract account by crediting it, reverse it to forward contract. It is not required because the account is settled 10,000, and to P&L account this year I will recognize a profit of 1 lakh into difference between 31st March rate and today's rate. Total gain is 20,000. 10,000 was recognized in last year and 10,000 is recognized in current year because of the exchange rate movement. Because of the exchange rate movement. Is it right now? Please let me know if this is right. Have you understood this chapter? Have you understood this chapter? Say yes or no. This answer is over, and this chapter is over. Thank you. Bye bye.